morning. Welcome to 3 Minutes on Markets and Money. As the S&P has made 44 record closes this year, been pretty phenomenal this year. Fact that, well, basically has been a very low volatility run ever since last November. Small dips back to the 50-day moving average continue to be bought. In fact, the dip that we saw just a couple weeks ago saw the largest push by retail investors jumping into the markets. They did get a little bit of gain here, but not a whole lot. And again, while the market did make new highs on Friday, it was just barely so, just a fractional new high. The real issue here, though, continue to watch. Money flows are weakening. Yes, our buy signal still in place. So again, nothing really to worry about here at the moment. But we are entering into a seasonally weak period of the year. And as we continue to really look at this, pay attention to kind of how this market's behaved. We've had these nice runs. The market then kind of flatlines here before the next decline, at least back to the 50-day moving average. We've seen this numerous times. In fact, every single peak that we've had in the markets that led to a previous correction have been this function of a rally, a flat line kind of stalling in the markets, then a decline. And these have corresponded specifically with our money flow sell signals repeatedly. And while we're not there just yet, we are getting close. So the setup for the next decline in the market is certainly well within the context here of the next 2 to 3 to 4 weeks. That's going to align potentially with a couple of things. First of all, the Fed is going to be hitting Jackson Hole here in about 2 weeks. Start looking for a timeline for taper and the magnitude of what that taper may mean. That potentially is going to lift some of the air out of the market. A lot of this speculation in the market that's been behind this run so far has been a function of the belief there is ultimately no risk in the markets because of the Fed. Well, if the Fed is going to take away that punch bowl, risk becomes much more prevalent to markets. Speaking of no fear in the markets right now, gold is another kind of interesting conundrum happening in the markets, despite the fact that a lot of people are concerned about inflation, about slower economic growth, the virus, etc. Gold really has not been performing at all here lately. In fact, we continue to see a big break over on Friday on gold prices, gold dropping here sharply, a real lack of performance in gold this year. Gold, deeply negative money flows, currently on a sell signal now. Money flows deteriorating once again. Nothing good going on here with gold. But what is wrong with gold? Well, really nothing. What's going on with gold is there's no fear in the markets. And where gold really plays well is in the risk preference trade. When we begin to see more fear in the equity market, people begin to look for a defensive position against equities. Gold will likely be a beneficiary of that risk preference trade. In other words, risk on to risk off. One area that we're seeing this trade already occur is in bonds. But again, we haven't seen it yet in gold. Gold holding support here currently at current levels. But again, just a very, very weak trade here at this point. So again, if you're long a lot of gold here, be careful. You did break support on Friday. And again, there's not risk in the market to really put a fear trade in place for gold prices currently. So again, while there will eventually be a good opportunity to buy gold, it might be a little bit further out, maybe a couple of weeks or so. And particularly, I think we'll see this performing better if we do start hearing more about the taper talk itself or see more of a increase in real yields. Those are inflation adjusted yields relative to the markets. I'm Real Lance Roberts for 3 Minutes on Markets and Money. We'll see you back here tomorrow.